My slogan is not your ordinary bean counter. That came about maybe 35 years ago. I was working for a large CPA firm. I saw an ad in the Journal of Accountancy for a large CPA firm in Miami, Florida, that had just put up a billboard. Now, 35 years ago, maybe almost 40 years ago now, it was unheard of for anyone in the accounting or the legal profession to put up a billboard for their services. You were thought to be, well, if you were an attorney, you're thought to be an ambulance chaser. And if you're an accountant, I guess you were thought to be an attorney chaser chasing an ambulance or something like that. So, but the billboard was terrific. It said, we're not just bean counters any longer. And it had basically saying that they were not just your old stuffy, they did consulting. And I thought that that was a great slogan, and I modified it slightly for my own use. So it's turned out to be not your ordinary bean counter is my slogan. And the reason for that is you don't find too many CPAs that love to stand up in front of everyone and give a seminar presentation. And I really enjoy doing that, which is also why I sing, get up in front of people, and consider myself an extroverted introvert. Well, you know, see, I get to do a couple of jokes in person that I can't do on Zoom. And one is, do you know how to tell the difference between an introverted accountant and an extroverted accountant? Well, an introverted accountant stares at his shoes when he's talking to you, and an extroverted accountant stares at your shoes when he's talking to you. All right, that's one. I have a couple more later. Today, we're going to talk about 10 tax strategies for Schedule C taxpayers. If you have a home-based business, you are likely to be a Schedule C sole proprietor. Schedule C is the form on the federal tax return, your 1040, that you report your income and expenses for your small business, self-employed business. At this point, I do like to ask, is anyone here have a business that's an entity other than a Schedule C, like an S corporation? Everyone here is a Schedule C sole proprietor. I guess we can't really ask. Let's see, I got to get in the frame here. You know, I can sort of see myself when my head's cut off.
Is that better?
Yeah, it's a little better.
Okay.
I don't want to block that, but hello, people at home. Oh, I guess it's here. I don't know. As a Schedule C individual, there are quite a few benefits in the tax law that can help you minimize your income taxes. Here's 10 of them. If you have questions, please ask them as we go. I like to answer. It helps with discussion, makes the presentation a little more lively. Don't save them up and wait for the end, because I like them in context with what we're talking about. And then I may offer a few other tips and tricks that if we have time at the end. Now, I don't know how long we're going till 9. Okay. Good. So let me tell you, let me tell you, yeah, that's right. You got to take advantage of it. I'm looking at the wrong page, so that doesn't help too much, does it? Let me get back to the Schedule C. I actually brought 10 tips, tax tips for S corporation shareholders or owners, and we can touch on that a little bit, because one of the things that I get asked all the time by small business owners is it worth it for me to become an S corporation? Should I become an S corporation? That's kind of the evolution of your small business as it's growing. And I will touch on that in the next hour and a half that we have together. Number one, what I've given you here is, and what you see on the screen is the Schedule C for 2021. And highlighted in there are the different places where you would put the amount or that would apply to the strategy that we're going to talk about. So strategy number one is actually on line 14. It has to do with employee benefit programs. And if you turn the page, you will see that it has to do with deducting health insurance premiums with a Section 105 cafeteria plan. How many of you are married in the group? Okay. And how many of you actually work with your spouse or have your spouse as a co-owner of your business? Okay. One of you. It is a great idea to not have your spouse be a co-owner of your business, but rather employ your spouse in your business. That can work the other way as well. Put the business in your spouse's name and be employed by your spouse. That works really well for Schedule C small business owners because you can then create a Section 105 cafeteria plan and reimburse your spouse for all of your spouse's medical expenses, including your spouse's family. That means you. That turns all of your medical expenses into business deductions. Whereas if you don't set up a cafeteria plan and reimburse your spouse for medical, for the spouse and family, you have to deduct the medical expenses on Schedule A as itemized deductions, and very few people get any benefit out of medical expenses on Schedule A. Primarily because there is a 7.5% limitation on medical expenses, meaning that you have to have more expenses, more spent on medical than 7.5% of your income is the only amount that will be deductible as part of itemized deductions. Problem two, the second hurdle is the Tax Cuts and Jobs Act of 2017, which began in 2018, otherwise known as the Trump tax bill, doubled the standard deduction. Everybody gets to deduct either the standard deduction, which for married couple is $25,800, I believe, pretty close to that. They change it a couple $100 every year for inflation. $25,000. It used to be 12.5. Then they doubled it. So if your medical expenses do exceed 7.5% of your income, the first 7.5% is just gone, disappears. That's the subtraction. What's left over then adds to mortgage interest. Mortgage insurance was deductible. Your real estate taxes, income taxes, state taxes, and charitable donations. All of those added together must exceed $25,800, or you're just going to take the standard deduction, which you're entitled to anyway. So very few people many fewer, there's got to be a better, that's always an oxymoron to me. There's got to be a better way to say a lot fewer people are deducting their itemized deductions anymore. They're taking the standard deduction. Caveat, not caviar, caveat is Oregon still has a very small standard deduction. For married couple, it's about $3,700. Most people can easily, in Oregon, can easily exceed $3,700 of deductible items. So you don't want to forget about itemizing your deductions. You still want to gather your charitable donations and your mortgage interest and property taxes, although state income taxes are not deductible on the state return. But all those other things are still come into play for the Oregon return. But as far as medical, you just lose it. Not if you hire your spouse and reimburse those medical expenses. They should be reimbursed on some kind of regular basis, not just once a year at the end of the year. It needs to be as you would with a legitimate, a bona fide employee. It could be quarterly, monthly is okay, but your spouse needs to gather all of the receipts for medical, for the spouse, and for you, the business owner, as the family, turn in those receipts and get a check from the business. And now you've just turned those into employee benefit expenses deductible on Schedule C. Strategy 2. Do we have any questions about that?
So
By the way.
Absolutely clever, Mr. Bond.
Yes, I like to do the clever things. Strategy 2, employ your child. Now I can see right now in this group, I don't know how many of you have children left at home, but they have to be under 18 years of age. And that might not be, I don't know how many people at home. I guess I look this way. Because whenever I look that way, I'm looking that way on the screen. So in fact, you know what? That's probably what I need to do. Dun, 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 dun. We got it. Figured it out. If you have children, I'll just mention this quickly and then we'll move on. If you have children under the age of 18, you can hire them and pay them up to the standard deduction amount, approximately $12,500 annually. That will be wage expense on your Schedule C. They do not have to file a tax return. And it's not subject to Social Security and Medicare. It's not subject to any payroll taxes if they're under 18. So you wish you knew this how many years ago. But if you know anybody else that's in that situation, tell them, hire their kids. The kids need to do something reasonable in the business. I mean, some kind of business work. Mailings, they can update your Facebook posting, your business page on social media. They can help you with your website. They can, whatever. They could sweep your office. They can wash the office windows at home, that kind of thing. Anything like that would work. You pay them up to $12,500. And the reason there's no tax return is because they get the standard deduction like every other taxpayer. So $12,500 is their wage. They get a standard deduction of $12,500. There's zero income. And the IRS says, if you make less than the standard deduction, you don't have to file a tax return, which also means you don't have to withhold any federal and state income taxes because they're exempt. So that's a good strategy. By the way, one thing I missed on the hiring your spouse. the reimbursement of medical expenses is considered their wages. So you can reimburse their medical expenses and you don't have to file payroll tax returns. That alone, and you just deduct all that medical as employee benefit. That is allowed. That's acceptable.
You got medical expenses. When you say medical expenses, are you including premiums and everything like
Yes.
that?
Yeah.
Wrong state.
So I've already mentioned number 3. I guess I should probably come down here. Number 3, instead of paying your spouse wages on a W-2, you can reimburse his or her medical expenses. So there's no payroll taxes due on the reimbursement of medical expenses.
Who wrote these laws? It just seems like this is one of the most convoluted opportunities.
Yeah.
For us little people. Or big people.
Well, it's not so much who wrote this law. What they did was they left a loophole in the law they did write.
Yeah.
They didn't, and it's very possible, as with everything else, that after a while they realize how much tax revenue they're losing, and then in another future tax bill, they close that loop. They do that every year. People think, oh my God, you know, we're having another tax overhaul that comes once every new administration. That's not true. We get a technical correction act at least once a year. Lately, in the last few years, it's been 3 or 4 times a year where they are going back and correcting. They're either correcting mistakes that the writers of the law created when they tried to interpret what Congress meant by their bill, and they didn't write it out correctly and include, so they have to go back and correct those errors, or they're coming back with new interpretations because they wrote something and just had no idea what Congress meant when they wrote it. And then Congress later comes back and says, oh, okay, you didn't understand. This is what we meant, something different. And then the IRS has to come back with a technical correction bill to finally apply the law that Congress intended in the first place. So this is an area that's been extremely, all of these are extremely well vetted, and they fall into an area that is not excluded, but maybe someday. But we'll worry about that. Yeah, we'll cross the Selwood Bridge when we get to it.
Maybe next year, they'll be able to give us the new version.
The new version, of course, exactly. The technically corrected version next time. Another item how you can use your spouse. Not abuse your spouse, just use your spouse, is to rent from your spouse. So if you have a building that you use as your office, not exclusively, can be a part of it. You own another structure in your home, you can rent from your spouse, the business can rent and pay your spouse for office rent of that space. You can't do it with your personal residence, so it has to be a separate, some kind of separate structure, building, an ADU that you use for your office space. Tool shed, yes. If you clean it out and have it's available for your work.
mean, do the couple need to have separate bank accounts, or like what if their finances are all mixed? You can't really say you're renting from your husband.
Well, this really only works if you've segregated your business finances. So you need to have a business checking account. You ought to have that anyway. And then you write a check to the spouse that puts it in your joint personal checking account. It's fine.
Okay, got it.
Again, an area that didn't get closed up in the law, where now you've generated expense that will have to be picked up by your spouse as rental income.
Right.
Okay, that's the catch.
Yeah.
So you're transferring. The question is, well, what's the benefit? If I get a deduction over here, but I got to pick it up as income, the benefit is a deduction for your Schedule C business saves you not only income tax, but self-employment tax, which could end up being more than your income tax. I don't know how many of you have experienced, a few $1,000s or whatever the amount is in income tax, and then you look and you've got 8 or 10,000 in Social Security and Medicare in self-employment tax. Well, that deduction then on the Schedule C becomes Schedule E rental income. So you're not saving any income tax, but you're saving 15% Social Security and Medicare as self-employment tax.
And then you could potentially have expenses due to maintaining the structure as well.
Well, that's correct. So if the rental income can be offset by those direct or a portion of indirect expenses for that tool shed. You depreciate the tool shed against the rental income. You have maintenance. You're going to repaint the tool shed. Those all can be deducted against the rental income. Any questions about that?
So my bookkeeper, when I have a board of directors meeting
Yes.
in my home office, I rent my home office to myself personally. So my business writes a check for a couple of $100 and pays it to me personally
Mm-hmm.
because I'm having my BOD meeting
Right.
in my home office, which is in my house.
Yes. And you can do that.
Yeah, it's also plumbing.
Right. The rent must be market value.
Mhm.
You can't decide, oh, I'm going to pay myself $100,000 to rent it out for a couple days for a board of directors meetings. It would have to be reasonable.
Mhm.
But unfortunately, with a lot of things from the IRS, that's all the guidance we get. Reasonable.
Yeah, and you have to have the BOD minutes of meeting and make it official, but it can't just be fiction.
Correct.
It has to.
You're going to have to substantiate it,
Yes,
provide evidence
exactly.
of what you used it for. Mhm. That's a great benefit to actually, you could rent out your entire home for up to 14 days to your business.
Yeah, they call it the Augustus rule, right?
The Augusta
The Augusta
rule,
yeah,
correct.
That's what they told me.
Augusta, Georgia is where the Masters golf tournament is played. And a lot of homeowners in Augusta, Georgia, when the Masters comes to town, they rent out their homes for 50,000, 100,000, whatever it is, if it's very close, and these huge sort of Georgian mansions. It doesn't matter the amount of rent that they collect for that 2-week period, but it's tax-free. You can rent your home out for up to 2 weeks during the calendar year. It doesn't have to be consecutive either. Weekend here, weekend there. And I'm not talking about Airbnb. I'm just saying you rent out your entire home. And they do that for people, families and groups that come in for the masters. And the law says if you rent your home, personal home, for up to 2 weeks a year, whatever rent you receive is not taxable. And of course, you don't take any deductions or anything for it either, but you can do that. So you can rent your home out to your business as an employee retreat, for example, for a week to employees and write that off. And it's not even Schedule E rental income. And if you won't see, it doesn't say the Augusta rule in the tax code. That's the nomenclature, that's jargon.
Reporting that somewhere on your return?
You're reporting it as rental expense. Oh, if you're saying you're renting it out and getting the income, no, it's not reported. It's not reportable. You don't report it anywhere. You do have to keep the documentation. Because if you do get audited and they come up with, they look at your bank statements and say, what they'll do in an audit very often, most often with small business owners is do what they call a cash reconciliation. They'll take all of your bank statements, personal and business, add up all of the deposits in all those accounts, subtract transfers from one account to another, subtract what is reported on the return, and they come up with a remaining balance. Could be gifts, could be garage sales, it could be renting out your house for 2 weeks. They're going to ask for documentation. If it's a few $100s, I mean, birthday gifts or whatever it is, you know, that's falls under de-minimis rule and they're not going to bother with it. But if you rented out your house for 2 weeks for $50,000 and you got a $50,000 deposit, they want to know what that is. Otherwise, the default is always to claim it as business income, even if you know it's rental income. But they'll say, no, you have a small business, this is business income if you don't have any other documentation, and they'll charge you income tax and self-employment tax and penalties and interest. So just document it. Home office
Can I
expenses,
just ask
you
real quick?
may.
So if you, let's say, said, here's a document that shows prevailing market rates, that's proof evidence, and then here's my check to my joint account for that amount. Would that be sufficient?
Yes.
Okay.
Mhm. If it's going to be, I would say one other thing. It would be good to have some kind of contract,
Okay.
an invoice
Yeah, that makes-
signed that says, you know, if you're going to rent out your home for a
Yeah.
week or two to some group, you'd want that anyway, I think, just for legal purposes. So if they damage
Whatever.
anything, they're responsible.
Yeah, whatever you would do if you're renting it to someone else,
Sure.
just do it for yourself.
Right. Right. Strategy 5. Now, of course, I'm talking to the Association of Home Businesses. All of you are deducting an office in your home. Probably don't have to go into this very much. However, there is something that is little known by home office businesses, owners, and that is that in an effort to make the percentage use of your home as big as possible, you are allowed to subtract the square foot of hallways, stairwells, closets, and bathrooms from the total square foot of your house. So that's the denominator. The numerator is the square foot of your office space, including the square foot of garage, portion of the garage, if you use that for storing office supplies or product, if you're in a retail type business, could be basement area. Now, when it comes to garage or basement or attic, you must include the total square foot of those areas in the denominator. So if you're going to say, well, I use another 200 square foot of my garage for product, well, how big is your garage? 500 square feet or whatever, and you have to put 500 square feet in the bottom number as your total square foot of your house. But you can take and subtract hallways, stairwells, closets, and bathrooms. Yes, subtract that from the total square foot of your house, and you'll get, you'll eke out maybe another 1 or 2%. And that will maximize your office and home deduction, which you then multiply by, or you multiply that to your mortgage interest, your property taxes, your landscaping, gardening, utilities, insurance, etc. Your alarm system, whatever.
So I have a question. There's different answers, so I'm curious in your opinion. So I did read somewhere that you can only take your home office expense if you have a profit in your business. If there's no if your business hasn't made a profit, you can carry over the home office expense to the next year or the next year until your business makes a profit. Have you heard that before? What's your take on that one?
It's not just that I've heard it, it's that I know the rule,
Tell me the rule.
and the rule is you're correct.
Okay.
You cannot increase a loss or generate a loss with a home office deduction.
Okay.
That is absolutely correct. Now, if you, well, the renting the office out, like you said, to your board of directors meetings, and then being able to deduct, that'll generate income on your Schedule E, which you then can deduct the home office expenses for that period of time from your Schedule E income, rental income. So you could capture it a little more that way. But yes, you're correct.
But that means your total income. So this is not just because my business, I fill in a Schedule C. So I have income from my husband's W-2 and income or loss from my business. And then that total amount goes on Schedule C. So in Schedule C, you don't have a loss because we include the W-2 income.
No,
So
don't
there's no
include
loss.
his W-2 income on Schedule C.
Well, sorry, not in Schedule C, in 1040, is it
1040,
Yeah,
yes,
1040.
yes,
So 1040 doesn't ever have a loss.
correct.
So there's no loss on our tax return. But if you were to separate it out between my business and his
W-2 income,
my business has lost money.
yes.
So
And we're looking at, in order to deduct the home office expense, you're looking strictly at the Schedule C profit and loss,
okay,
regardless of any other income and expense.
regardless of the 1040 number.
Correct,
Schedule C.
correct.
Okay.
In fact, if you look at the Schedule C specifically,
Yeah.
let's go back up to that. Right there, I don't know if you can read it. It says, right up here, expenses for business use of your home. do not report these expenses elsewhere. Attach Form 8829 unless using the simplified method. And let's see, does it actually say it on here? Well, the rule is, so you figure it out. What you do is you figure it out on Form 8829, which I don't have with me here, can't show you that. But on 8829, you calculate the total expenses that are allowable, including, don't forget to include depreciation of your home. The rule used to be that, and this got a lot of people into trouble. The rule said you must, I'm going to skip on to another issue here when I talk about this. That's why I'm hesitating for a moment, how to put this in the right context. When you go to sell your home, you probably all know that if you're single, $250,000 of profit is excluded from income tax if you've owned and lived in your home for 2 out of the last 5 years. Now, there's some screwy rules that say it depends on if, looking back at that 5 years, whether you rented it first and then moved in as a residence, or you had it as a residence and then rented it out. The whole issue was people would have a second home. So they'd want to live in it for 2 years and then they'd sell it and move into their other rental. And then they live in that for 2 years and try to get another 250 or 500,000 if you're married of tax-free income from the sale of your home. I won't get into all of that because there's some specific rules that relate to that issue. But if you've lived in it for 2 out of the last 5 years, generally speaking, you get that exclusion of $250,000 or $500,000 of profit on the sale of your principal residence. However, up until 3 years ago, the rule was you had to recapture depreciation on your home that you took as an expense for office in the home expense. And that meant some of that excluded gain you'd have to pick up as ordinary income because you got a deduction and now you got profit from it and now you have to pick it up as income. A lot of people said, oh, I'm not deducting an office in the home then, because if I'm just going to have to keep track of my depreciation and I'm going to have to add it back when I sell the place, it's not worth it. And I always used to say, well, the deduction today, those tax dollars are worth more than in 5, 10, 15 years from now when you go to sell the home and have to pick up the income and get taxed on it then. Generally speaking, you might be in a lower tax bracket anyway. But if I can push off the tax, I'll take the deduction now and defer the tax till later on. Well, 3 years ago in the TCJA, the Tax Cuts and Jobs Act, they did away with that rule. You no longer have to recapture depreciation on the sale of your home.
Wow.
So if you didn't know that, now you know it. If you had heard something about, I'm going to have to recapture this depreciation when I sell my home, now you can be dispelled of that notion.
Wow.
You don't have to worry about it. So take the depreciation. More incentive to deduct everything you can with an office in the home.
Wow.
If it's rental properties, still the same. When you sell rental, let's say you live in it 2 out of the last 5, you went from a, went from primary to main. Take this one, 2 out of the last 5, you live in it, you sell it, you still have to recapture the depreciation.
You do.
From when you had it as rental.
Because for a period of time it was commercial real estate. And so for the period of time it was commercial, then yes, you have to recapture that. Depreciation recapture, yes.
I have a technical question about office Given, 300 square foot apartment, which I'm not gonna deduct the stairs and the hallways and the bathrooms. and that 300 square feet.
Uh-huh.
But I've been reporting, I think about 80 square feet is my home office, but it's really just like sections of my, living space that I primarily, I have tables set up, I've got 3 computers, 2 different tables and a printer. Spend most of my time. So, once in a blue moon, I might have people over and clear off the table and have dinner. So that doesn't happen much, and I think it's COVID. Is that still legitimate for an office deduction?
The rule for an office in the home deduction is that it must be used exclusively for business. So if you have an audit and they ask you about that, you never do anything in that space other than business.
Yeah.
You don't entertain neighbors, you don't entertain family, no, never. You do business work, because if it's used for any other purpose, which is to say, if I'm in my living room and here's my big screen TV and I've got my desk set up right here, it's not going to work. If I'm over, in another part where so a part of the room is okay, but you really have to, you have to demonstrate that it's used regularly and exclusively for business. So if you can do that 80 feet that goes around, then yeah.
I have some technical questions about the capital gains, but I'll ask you later, or maybe consider separately.
Okay. Yeah, they can be. Yeah. That's why we started out with coffee. Kind of keep you, yeah, going bleary-eyed. All right, any other questions about that? De minimis fringe benefits. Now, this specifically relates to having employees. It can relate to your spouse, your kids, if you've set them up as employees, like we've already talked about. Then various expenses for birthday presents and Secretary's Day, flowers. The list includes, well, this is on the IRS website, controlled occasional employee use of a photocopier for personal use, obviously for business use. I mean, that's business, but occasional snacks, coffee, donuts, etc. Occasional tickets for entertainment events, holiday gifts, occasional meal money or transportation expense for working overtime, group term life insurance for employee, spouse, or dependent with face value not more than $2,000. So it's going to be pretty cheap insurance. Flowers, fruit, books, etc., provided under special circumstances, and I won't go into what those special circumstances are. Generally, it has to do with, these are very occasional type events. Personal use of cell phone provided by an employer, primarily for business purposes. Normally, if they use their cell phone, well, if I give somebody a cell phone and they use it for personal use, just like if I have a company car and my employees use it for personal use, I'm required to add a value to their W-2 because they've been given in lieu of wages a company use of car, company use of cell phone. But if it's occasional, oh, I got to check on my grandma, she just went into the hospital, can I borrow, the phone or whatever, it's personal. but it's de minimis. The amount is so minor that it's not worth trying to keep track of all these nickels and dimes. So, but they can add up. There is no dollar amount associated with de minimis. There's no definition. It's just pretty minor and occasional. But again, might be another $1,000 deduction. And $1,000 deduction could save you upwards of $400 in tax. You know, $400 to $500 in tax when you're talking about, depending on what tax bracket, income tax bracket you're in, federal, state, self-employment tax, TriMet. If you're in the city of Portland, like we are right here, then there's the Portland business license, Multnomah County business income tax. If you make over $200,000, you've now got 2 more income taxes because everybody voted for it, right? Everybody voted for daycare for all. 200,000. If your income, your gross income or adjusted gross is over $200,000, you're subject to 2 more income taxes. It's daycare for all, and it's another housing. There's Portland is trying to generate more revenue to homeless assistance. So, but it reduces, so fringe benefit, de minimis fringe benefits can reduce that, all of that tax. Strategy number 7. Heavy vehicle deduction, which leads actually to another issue as well. You've all heard, maybe you've heard that if you buy a vehicle over 6,000 pounds, you can write it all off. And that used to be the case, and then it wasn't the case, and now it's the case again. So if you buy a vehicle, the GVW of which is over 6,000 pounds, it's considered a truck. It's in that same category as a truck, and a truck was always considered a business vehicle if used in a business, without question. It used to be that the law said you could deduct 100% of the cost of a vehicle under section 179, which is the section that says write off all of your business equipment 100% in your business. And people were running out and buying SUVs to get that deduction on the last day of the year. Now, what you had to do, and what you still have to do, is you have to multiply the cost by your business usage percent. So if you ran out and you bought a car on December 25th for your Christmas present, that was $60,000, and you used it exclusively for business for those 5 days, 100% business use just for 5 days, you could write off, you used to be able to write off the full $60,000 in your business, with a big caveat. And that is, if your business usage percentage ever dropped below 50%, you had to recapture as income all that expense, and then you deducted straight line method over the next 5 years, the actual depreciation times your business usage percentage. So if it really wasn't a vehicle intended for mostly business, you could get yourself into big trouble. Then the rule is, then Congress said, oh God, we didn't mean for everybody to go out and spend $60,000 to $100,000 on a vehicle and get all this tax write-off. So then they limited it to $50,000. And then a few years later, they limited it again to $25,000. And it's been sort of this $25,000 is where we sit, except for the Tax Cuts and Jobs Act, the Trump tax bill, which allows 100% bonus depreciation. So you could write off the entire amount under bonus depreciation. You could write off 25,000 under section 179 and the rest of it as bonus depreciation. With the same rule, of course, that you have to continue using it more than 50% for business. Otherwise, you got to recapture all of that 179 and bonus depreciation. Now, the bonus and the 179 are elections that you have to make. If you've made the wrong election, you can still go back 3 years. So we still have the possibility of amending 2018, 19, and 2020. 2018 deadline, if you filed timely or before, another comment, before April 15th of 2019, you have until April 15th of 2022 in which to amend your 2018. If you extended the return to October, then you have until October of 2022 to amend your 2018. If you filed until 2018, we didn't have the additional extension from the IRS. That was in 2019 and 2020. Okay, 2019 returns in 2020 weren't due until July, and the returns last year weren't due until May. Okay, however, be careful if you're intending to amend your returns, because the IRS has made it clear that they did not extend the deadline. The word escapes me now. Somebody at home is probably looking it up furiously right now. But it wasn't deferred, but essentially that's the idea. They basically pushed the deadline. They granted an allowance for extra time, but they didn't consider that an extension of the due date, which means that if you're going to amend and you filed your return, let's say for the 2019 return, you filed it in June because you had until July and you didn't file an extension form, which you didn't have to do, you still only have until April 15th of 2023 in which to amend a 2019 return. You don't have until June
Grace
of that
period.
year.
Grace period.
Well, yeah.
So
There's a term, it's actually another word that starts with E, but it's not extend. I'll have to find it. I'll have to remind myself of what that is. But the idea is 3 years from the date of the return was originally due with or without extensions. So if you filed an extension by April 15th of 2020 for your 2019 return, you had until October. Maybe you still filed it in June, but you had until October, and now 3 years later becomes October 15th of 2023. So that's how that works. I'm going to mention something serious, as if I haven't been serious up till now. If you don't keep a mileage log contemporaneous, that means some kind of daily log, doesn't matter the exact form. You can scratch it on a piece of paper. You can put it in your Outlook calendar, your Google calendar. You can use Mile IQ as an app I love because it's just swipe left, swipe right for business or personal. QuickBooks has an app. It also tracks mileage. It doesn't matter what you use, but you must keep a mileage log. If you don't, you will not win an audit of your automobile mileage, and they will disallow it 100%. And mileage expense can be a decent number on your return. on your Schedule C automobile mileage. I have been through a couple of audits. That is a hot button for the Oregon Department of Revenue right now. They are auditing specifically automobile expenses because they know now people don't keep mileage logs. And most of my clients don't. And I tell them every year, I will put on your return what you tell me is your mileage. And you must be able to show a mileage log in order to support the deduction on the return. That's your problem. It's not my problem, but you need to know that. You're gonna lose if you don't keep it. Yes.
So you say keep a log, does that mean every time you get in your car, you're making a note of where you're going, what you're doing, what your mileage is? Or is it only when you know you're getting in your car to do a business errand? And then, you know, the mileage from when you start, the mileage from when you end with the day.
Only for business, because that's the only part that you're deducting.
Right,
They don't care how much you use your car for personal, you're not deducting it.
yeah, okay. So just keep
But
that
business.
on track.
The one other mileage number you need is the total number of miles you drove the car. Because they want to understand two things. They want to know how much you use it, and they want to know if you've gone under 50%. Because that 50% rule falls into other rules regarding depreciation and things like that. Even if you decide to take actual expenses, you need to keep track of your mileage. Because you have to be able to get to arrive at a business use percentage. Then you multiply that times all of your actual operating expenses, times your depreciation, times your gas and oil, times your whatever you spend, insurance, etc. Or the other method is you can take the standard mileage allowance, which is, of course, directly related to how many miles you drove for business. But they still, on the tax return, there is a place to put the total number of miles that you drove. That's easy, relatively. One is take a photo of your odometer every December 31st or January 1st. Just one, because every year now you can say, I'm just going to subtract the two photos. That's the total miles you drove for the year. You don't have to track it any more than that. For people who haven't done that, what I tell them is find a repair bill somewhere near the beginning of the year and somewhere near the end of the year. They always keep an odometer reading. You can subtract the two and then you can multiply it out, you know, extend it out for the rest of the year. Extrapolate the mileage for the entire year. That's good. That's good enough for total.
What's the per mile this year?
56 cents. It's been going down, actually.
Yeah.
It was 58.5 2 years ago. Even though gas prices gone back up again. So probably next year the allowance will go back up again. But I cannot urge you enough. I have a client who's an outside salesperson for fly fishing equipment, and he's got the 5 Western states, and the guy puts 35,000 miles on his car every year, driving all, because he's visiting all the fly fishing spots, retail stores, showing them the latest flies and all of that, and repping that kind of, and the Oregon Department of Revenue has disallowed all of his mileage because he didn't present. Now, he wanted to do the audit himself, save a few bucks, not hire me to represent him. That's a separate service. I prepare taxes, but I also represent. He didn't want me to do that. He could handle it himself. And they disallowed all of his business mileage, 100%, because he did not provide a contemporaneous business record. And after getting together with him, after they'd already issued their report, I said, don't you have anything that you recorded? The guy's pretty meticulous. I mean, he had envelopes legal, manila envelopes full of receipts for every meal and every place he slept, and logic proving that he was in these locations, and car gas fill-ups from all these locations. It didn't matter. The auditor said, you didn't keep a contemporaneous business mileage log, and the IRS says you're required to. So I said, don't, with all these receipts and everything that you provided to them and whatever, didn't you keep a mileage log? Oh yeah, I have a day planner. It's a day minder. I write in, what car I drove and where I went and who I talked to. Give me that. Give me that. So I filed an appeal. They assigned a new auditor, and I had to tear apart. It's one of those little spiral bound things. I tore it apart, cut off the little fringes, scanned the whole thing, because now everything is done, COVID wise. It's all done. They're at home and they want everything sent in. I didn't email it. I sent it through the Revenue Online portal. And I'm crossing my fingers that it's enough. He penciled it in. Mileage, where he went, and how much miles. So I'm we'll see. If they disallow it still for whatever reason, I'll have to find out, and that's of course their prerogative. The next step is tax court if he wants to fight it. But he's got close to $10,000 owing because he didn't provide a mileage log, which would have cleared it up right from the get-go. Okay, so those are vehicle expenses. Number 8, domestic travel. If you travel within the United States, and it has to be for business, the majority of the trip, of the time that you spend away is business related, you can deduct 100% of the trip, even though you take some side trips to Disneyland or Epcot or whatever. You don't get to deduct the entrance tickets to Disneyland. That's not a business expense. But the extra couple nights you spent at the hotel and the meals that you had to eat because you were away, you get to deduct all of that as business travel expense. Now, my recommendation is, because this is something that they do look at, schedule a business meeting at the early part of the trip and schedule one at the end of the trip. Because another rule in this area is if it was cheaper to stay there because you had another business trip than it was to come back home and then return, then you get to deduct 100% of the transportation. So plan out your business that way, early on, later on, and you'll get to deduct everything in between related to your stay. It says that there are 5 rules. 5 rules for turning your vacation, even a luxurious one, into tax deductible business travel. And I have those 5 rules that I will read to you. Number 1, you have to have a profit motive for going. You can't go and just say that you're trying to drum up some business. The problem for all of us in business is the IRS has generally 3 years to look back at what we did 3 years ago, because that's the kind of schedule they're on for auditing. They won't audit you right now. They'll audit you in 3 years. And then if you can't show that you actually generated any revenue from your trip to Hawaii, that's going to be tough to say that you were there on business. Okay, so it's just something to keep in mind. You do have to stay overnight. If you just went and came back, then there's no meals allowance. Of course, if you didn't stay overnight, then there's no lodging expense. You can deduct, for self-employed individuals, you can deduct the per diem rate for meals and incidental extras, M&IE. And there is, the Department of Labor and Industries has a chart. You can go on there, it's really great, it's very detailed. You can select the year that you went, and you select your destination, and they will tell you during what times of the year the per diem rate is for that location. Now, that per diem includes also lodging, but you can't use the per diem rate for lodging. You have to use your actual out-of-pocket cost for lodging, but you can deduct the per diem for meals and incidental extras. The reason the lodging is there is that's the rate that the IRS says you can reimburse, you can use to reimburse your employees for their travel expenses. 3, apply the for only test. When you plan your trip, ask yourself whether a rational business person would travel for only the business reason. Or is the personal element so important that the trip does not make sense without it? That relates specifically to travel for educational purposes. You're going to go to France, to Paris, to find out how they do graphic art in Paris. Well, is that something you could learn here at home? Could you, I mean, and now with the internet, it's hard on Zoom. It's hard, 10 years ago, 5 years ago, that might be the case. Yeah, I can only learn about Indian, South American underwater basket weaving by going to, by going to Peru. But today you can learn about that through Google. And 5, as I said regarding travel, regarding car expenses, maintain good records. Document. So if you have a meeting at the beginning of the trip and a meeting at the end of the trip, document the meeting. Take notes. Have them give you a business card and whatever, something. The more documentation you have regarding that, the better off you'll be. Any questions up to this point? I'm going the wrong way. Foreign travel. If you travel outside the United States for business purposes for fewer than 7 days, you can deduct 100% of your transportation costs getting to and from your foreign business destination, even if you only work 1 day. And you can deduct your meals and lodging for business days as well. So the idea is, because it's foreign business travel, they allow you to deduct all of your transportation there and back, because they've granted the allowance that fewer than 7 days means that there's more emphasis on the business. purpose. But again, you have to look at those other 5 tests. You know, the 4 only. Did you have to go there for legitimate business reason? If you're there longer than 7 days, then other issues come into play. It doesn't mean you can't deduct all of your transportation. It does have to do with, is it cheaper to stay than it was to fly home and then fly back again? You know, you stay for a month on the Côte d'Azur and, you know, that for business. So generally speaking, then what happens is, in that case, you might have to prorate. You had a business meeting that was 1 day, you stayed there 30 days, you can take 1/30 of your transportation.
Now, if you're going, let's say, 7 days on the coast of France and then 7 days in the Black Forest of Germany, would those be considered separate international trips? It's all one trip.
All one trip.
That damn rational person, they're always figuring out things.
But that doesn't mean you don't get to deduct any of your business travel. It just means you'd have to prorate for the number of business days and the length of the stay.
Have clients everywhere is what I say.
Have them everywhere, right? Cell phone expenses. So if you provide an employee, including your spouse and kids, with a smartphone, it's considered a working condition fringe benefit that it's excludable from income. When we talked about providing a car to your employees for any personal use, even that personal use includes commuting from home to work, then the mileage allowance, 56 cents a mile, would have to be multiplied by their personal miles and added to their W-2. That doesn't pertain to cell phone usage. And cell phone has always been sort of this strange beast, which is today you can't do business without it. It's not a cell phone, it's a computer in your pocket, it's your email, it's your messaging, text, it's your calendar, could be your mileage log, etc. You know, it's everything that you need for business, or you need it for business. Not everything you need, but it's one of the things that you must have for business. And for the longest time, the IRS was always trying to figure out this business usage percentage, kind of like buying a computer for your business too. Well, how much time do you put on? Well, nobody's tracking time, minutes, playing games. So what the IRS has really come down to with things that are called, these are called listed property. A cell phone, a laptop, and the one at home, a desktop at home, even your automobile, they're all on the listed property list as equipment, as property that you split between personal and business use. That's what listed property means. I use it for personal and business. And for a long time, they wanted you to come up with some reasonable split of business and personal. Now, if it's a laptop and you have a desktop at home, that can be 100%. You could argue easily that that's 100% for business because you've got another phone, you've got another computer at home that you won't deduct. Or you could deduct a portion of it, half of the cost, 3/4 of the cost, something like that. You had to kind of carve out some personal use. And a cell phone was the same thing. They tried to get you to tell them, well, how much you use it for personal. In fact, what I tell clients up until today, because this is specifically for your employees, their use, you're paying for their use of a phone. And if they use it for personal purposes, the IRS is saying, we're not gonna bother with it. You gave it to them because you needed them to have it for business. And so you can deduct 100% of that. But for yourselves, I tell clients, carve out 10%. Just your phone bill is $1,200 a year. Take $120 and call it personal. Deduct the other $1,080 and call it that business. And then if you get into an audit, you can say, okay, you acquiesced. You used it 90% for business. You let them have their 10% not deductible. $120 would save you $50 in tax. It's worth just taking that off. Make it 90%. Kind of a rule of thumb. So we've got about 2.5 hours left. Let me talk a little bit about two things. I forget your name. Ken. Ken, that's right. I was thinking when you first mentioned it, I thought, oh, another Kevin. No, Ken. I hope you don't mind that I identified you as, we had this conversation about being in the stage, and this may pertain to the gentleman back there as well, retiring, having a business or an interest, and getting to that point where it's really a side effort, enterprise. It's really on the side. The IRS does have a rule colloquially named the hobby loss rule. And the hobby loss rule says, if you make a profit in 3 out of 5 consecutive years, they cannot come back and audit you specifically for the hobby loss, specifically for having losses in 2 years. So if you can find a way to generate a profit in those 3 years, even if the other 2 years you have larger losses than those 3 profitable years, the IRS can't come back and audit you for that hobby loss rule. Now, what is the hobby loss? A hobby loss is where you have some business enterprise that you're not in it for a profit. You cannot demonstrate a profit motive. Remember that the IRS has 3 years of hindsight to look back and say, 3 years ago, were you in it for a profit? It's easy to say, oh, I'm in it for a profit now, and then you have a loss for 3 years. So you have to demonstrate that you did everything possible to generate a profit, you just weren't successful. And that happens all the time. But again, it means more and more documentation. It means joining the AHB. Ding, it means having a website. It means having business cards. It means going to networking meetings. It means advertising on Facebook. It means having a business page on Facebook or Instagram or Twitter, LinkedIn, communicating with people on LinkedIn. You show all this traffic, and it's not always successful. But what happens is when you have a loss in 3 out of 5, in more than, well, if you have a loss for 3 consecutive years and then continuing, your chances of getting audited go up logarithmically. Doesn't mean you will get an audit. It means you're risking more and more the possibility that you will. And then you will have to demonstrate that you have a website and you have the business cards and you did everything, and you would join groups and you put yourself out there, you advertise, you marketed your wares, and it just wasn't successful. Under the hobby loss rules, what can you deduct? Up to all of your expenses, up to the amount of income you earn. So you can still bring that revenue down to zero profit. You just can't create a loss to deduct against other income. That's what they allow. If they determine that what you've got is a hobby and not a legitimate business with a profit motive. So that's one of the rules to look out for. Did you have a question? No?
Well, I'm curious about it because if you're just tinkering around, you know, and it's more of a hobby, art practice, I'm not really, I mean,
That's okay. We're not recording. Well, we are. Are we recording this? Oh,
and
shh.
like if you're such a small potatoes kind of operator, why is the IRS gonna, like, why are you even filing for that business? Where you, like, what point, like, at what point does it make sense to be reporting and filing with the IRS?
Always. Let me explain something. The IRS
It's like, hey,
says,
IRS, I got this hobby, I made $5 on this thing I sold. You know.
okay. Well, there are some de minimis rules. There is a de minimis rule. It says if you have under $400 of revenue, you don't have to worry about it. That's de minimis. But if you have more than $400 of revenue, I'm just talking about the revenue, you have to report it. Now, you can get a penalty for not disclosing all your income. It's like an errors and omissions type penalty. If it's so small and you can come up with legitimate business expenses that equal or exceed the amount of revenue, then you'll probably pass and not have to worry about it because the IRS will grant you those expenses. The issue comes in, and this is what I always tell my clients: report all of your income and report all of all the expenses you're entitled to. That way you can't be faulted for not disclosing what you do. If you make a couple $1,000 and you've got, you know, 5,000 or 6,000 in art supplies and, you know, yeah, all of absolutely. Report the 2,000, report the 2,000 of expenses, make it zero. And you have followed the IRS guidelines that say, and it's not the IRS, it's tax code. It's the, you know, Internal Revenue Code that says you're responsible to report all of your income that's subject to income tax, right? You don't report all of your income. You don't report gifts. You don't report inheritances necessarily. Things like that. Those are not taxable, so they're not reportable. But $2,000, $1,000 from your hobby, that's reportable.
Can I just interject also? You know, my husband he has a art component to his handyman business because he finds things and then he turns them into art and sells them for a nominal amount. But the thing is, what if someday we have a year where somebody buys one of his pieces for all this money and the IRS is like, what the heck? It's like, we always documented what he makes, what we pay, and the business exists and it's pretty transparent. So if we did have a year where someone bought something for $200,000, it's all there, you know.
Mhm.
So
Yeah, you've got that history to be able to show
Yeah.
what's going on. The other problem also is that if they find this extra income on an audit, then you have to go through the process of trying to convince the auditor that you've got all these legitimate business expenses, which is just an extra effort after the fact. Whereas if you did just reported it, 2,000 of income, 2,000 of expense, you can even have 2,000 of income and 2,000 of materials. Zero profit. Then you're golden at that point. The other thing I'll talk about, we were going to go to 9, or you said 9:30?
That's the kind of the outside edge of it.
Outside edge.
You
okay.
can stop earlier if you want.
Oh. Okay, thanks. Well, I just was going to give you my rule of thumb for when to consider converting to an S corporation. And this definitely deserves a longer discussion. Maybe that's for next time. If you have a profit in your business that's at least $15,000 over what you would pay yourself as an employee of your business, and that's again reasonable salary. That's all the guidance we get from the IRS. So it has to take into account somebody you would hire to take over for you, to do what you do in the business, to manage the business, to run the business, administrate, and etc. If you generate a profit that's $15,000 over that reasonable salary amount, you would be well served to take a look at whether it's worth converting to an S corporation. And the reason is that $15,000 of profit after the wages are paid to you, you save on Social Security and Medicare. You do not pay Social Security and Medicare, self-employment tax on the profit in a S corporation. However, that leads to the thought that many S corporation owners have, which is, well, I'm just going to minimize my salary and I'll have this huge profit. I don't have to pay any Social Security and Medicare, because on the wages that I receive, they're subject to employee taxes. I have to pay Social Security and Medicare and so on. And the IRS has said, that doesn't work. You are considered in an S corporation, as the owner, you're considered an employee of the S corporation. And you must take a reasonable wage. However, any profit after that is not subject to self-employment tax, Social Security and Medicare. And the reason I've set that at about $15,000 is that the savings, that 15% tax savings, which runs at about $1,500-ish, it's more like $1,750, is enough to pay for 2 other services that you wouldn't otherwise have to pay for. And that is having the S corporation tax return prepared, which is more expensive because it's more complicated than an individual return, and hiring somebody to do your payroll if you don't want to do it yourself. Because now you're an employee of your business and you are subject to all of the employment rules, withholdings, quarterly tax filings, a W-2 at the end of the year. You have to transmit tax payments according to the schedule, and if you don't want to deal with that yourself, then you hire somebody to do that, like us, because we do bookkeeping and payroll, as well as income tax preparation. Shameless plug. So if you hired it out, also I know Laura Frazee she's a bookkeeper. I've actually sent her a couple of referrals, clients to do bookkeeping and payroll. She's available. She's part of your group to do the bookkeeping and payroll. There's a shameless plug for you, Laura.
Thank you. I don't know if you can hear me, but I appreciate it.
Yes, we can, and you're welcome. So that's extra expense for you. But at about 15,000 of profit, you're saving enough to break even. So you'd either pay it in tax or you'd pay it in these extra services. So you're breaking, but then as your profit increases beyond, because your reasonable wage is static, but the profit can continue to go, you will continue to save more and more and more in your S corporation.
And that's the gap between a business, what you, like 30% self-employment tax versus say 17% business tax or something. That's where the savings is.
Yeah, well, it's 15% self-employment tax. And as an owner of your S corporation, you're also not, you can opt out of state unemployment. You can, there actually is a federal form. You can opt out of federal unemployment. You're subject to one of them. You are subject to, it just had this whole issue going on in my office. You're subject to either federal unemployment or state unemployment. One ends up being more expensive than the other. And the issue that I'm researching right now is, why would you pay more to the state? The federal maxes out at $420 a year. The state could end up being $1,500 a year. Why would you do that? Because you get better benefits from state unemployment than you do from federal unemployment. It can last longer. It can be a higher amount, but I don't know. I can't quantify it right now. I haven't been able
And
to.
I think state also can offer extensions, which federal doesn't.
Right. Yeah, that too, based on what you've paid in and so on. Yeah. So, yeah. So that makes it worthwhile. And thank you very much for your kind attention.
Great job.
Welcome. My pleasure.
Thank you.
You're welcome.
Well,
Let him eat cake.
There is some cake left and there may be liquid ice cream in there.
You can drink your ice cream.
Here's my ice cream. All right, so we need to kind of clean the table.
The silverware and the plastic plates go in the blue bin just beyond the table that has the coffee on it. It's on the floor. These little fiber cups are not recyclable, so they go in the trash. But the coffee cups go in there with a